Hi, everyone. There have been a lot of discussions that have been going on the last few years, and more so the last few months, so maybe the last 1 year, about whether active investing is lost its sheen and whether everyone should now become a passive investor. And I'll explain these terms a bit, but that's been the big debate, not only in India, but around the world. And around the world, there is a trend very clearly for passive investing, largely driven by low cost. So let's just look at what these terms mean and whether you, as an investor, as you read about all this, whether you should be making the switch from active to passive investing. So, a bit of background. I helped create Quantum Mutual Fund to give investors low cost, simple solutions for long term wealth creation by investing in India's growing capital markets. So, I started Quantum in 1990, so 31 years ago, and Quantum Mutual Fund, the first product we launched, was in 2006, so 15 years ago. And one of the great things I take pride of, and all of us I think at Quantum take pride at, so I'm not in Quantum anymore. I don't run Quantum AMC or Quantum Mutual Fund, but I helped start it and helped create the principles around which we were built. And starting with the first point, we refuse to follow the opaque entry load model. So at the time when we launched in 2006, distributors were getting a commission. No one knew how much the commission was. And we said, you know what, we're not going to do it. We'll wait for SEBI to force distributors and every other fund house, barring Quantum, every other fund house that was playing the game with the distributors, we said when they stop and when they start revealing, so investors know whether they're paying X% fee or Y% fee for a product, we certainly will not do it. And therefore, we pioneered what is now called direct to investor. We said our products can be available on the internet. There's no distributor selling us because we're not paying commissions. So if you really want to buy us, go on the internet and buy us. And this was way before smartphones became popular and when bandwidth was a lot less in India. And of course, there were fewer number of people with smartphones or iPads or even laptops. Um, and there were a bunch of other things that we did. We ensured that whenever someone redeemed a fund, it would be the distributor who would get the exit load, which made no sense to us. When someone redeems a fund, whatever the exit load is should go to the other unit holders in the fund because the fund is forced to transact to pay out the person who's redeeming. And yet the other fund houses very happily gave away your money to the distributors. So we said that's not what we're going to do. And we said there can only be one fee. There can only be one fee for all class of shares for all unit holders, whether you give Quantum 10,000 rupees or 10 lakh rupees or 10 crore rupees. We treat you the same. So we did that in 2006 when we launched. And we said, to be fair, the correct benchmark against which show that we're better or worse than the passive investing of buying an index or an ETF should be with total returns, where the dividends that companies give you is also reinvested in the fund as they are. So, for example, in our mutual fund, as they are in the index. And we had 100% board, our independent board of trustees. The majority of our AMC board were also independent directors. We had these, very unique paths to profits, which have now moved to the Zoom world, as much of us have done over the last 10 months. We started that in 2009 to really explain to investors what we do, how we manage money, our view of the world, our view of valuations, for right or for wrong. But that's what we think, and there we explained all that to you, why we think that way. And of course, in the liquid fund, we went from mark to market for all across all spectrums of holdings that we had. And in the regular plans, we had zero upfront distribution commission in August 2017 when we launched them. Now we do, of course, give some distribution commission, but we explain what that is, and it's very transparent. And effectively, all of these things that we've done prevented us from being a large fund house in terms of AUM. We did not buy away through distribution channels like other fund houses effectively have done by participating in these opaque practices. We said, you know what, we'll focus on what's good for the investor. So keep that in mind as we have the discussion of passive versus active investing. Um, like I said, on March 13th, 2006, we launched the Quantum Long-Term Equity Value Fund. It follows an active style of investing, which means that a team of fund managers, assisted by a team of research analysts, build a sensible value portfolio, which give you sensible risk-adjusted long-term returns. And our competition was the index, and still is the index. Like I said, the BSE 30 total return index, or the BSE 200 index, etc. It's a bunch of stocks. That's what the index is, a bunch of stocks selected by an algorithm created by the index providers. And these look at various historical data points, such as the market cap of a stock, its trading volume, the industry or sector in which the company operates, and there are a few others, but these are the main ones. And our belief was, and still is, that an active portfolio, in our case, using the value investing style, would do far better than an index, which really is a backward looking mechanism adopted by all index creators to pick yesterday's winners as constituents of today's index, right? They look have a rear view mirror and they say which company was actively trading in the past, which company has a large market cap. Those are the companies that I'll put in the index. So it's backward looking. It's a rear view mirror to give you today's index. Markets are forward looking, and value investors or any active fund manager, whether you're growth or mid cap or small cap, whatever you are, you need to find the winners of tomorrow, not chase the winners of yesterday. There was another flaw with an index. The creator of the index can happily change any stock at will. They can take a stock in or out of an index, right? And when they do that, if a fund which is investing to replicate an index, when the fund does that and tries to replicate that index, that fund or ETF has to pay a brokerage fee, STT, and custody fees for a live portfolio. So these are actual costs borne by investors in an index fund or in an ETF which plans to replicate an index. Hence, due to these costs that a real fund or a real ETF will have, which is trying to mimic the index, hence, due to these costs, 100% of all index funds, by definition, if they are true to form, if they are actually replicating the index, they should underperform the very index that they replicate, because the index provider's index has no transaction cost when they move stock in and out, whereas a fund or an ETF replicating the underlying index has to incur those real, live, actual costs. So quantum mutual funds philosophy has always been very clear, as I explained. We will do what is best for the investor. And having been the lead fund manager for a $2 billion Vanguard International Value Fund from July 1999 till April 2004, I was fully aware that eventually an index fund or an ETF would be a wonderful way for any investor to participate in the potential returns from the Indian stock markets. I recognize that. Vanguard, as you know, is one of the largest ETF and index fund providers in the world. They manage about $6 trillion, primarily from United States and investing in the United States. So having managed an active fund for them, they have a small part of their portfolio in active funds. And I was very lucky and privileged to be a fund manager for the Vanguard International Value Fund, an active fund. But I recognized the house. I used to go to meet Vanguard multiple times in a year. I would talk to the people, understand why indexing was so important, and they explained that to me. And yes, I said one day index would be big even in India. So We launched the Quantum Nifty ETF on July 10, 2008. So March 2006, we launched the Quantum Long-Term Equity Value Fund. And about 2 years later, we launched the Quantum Nifty ETF. We don't talk about it much, but it's there. It exists. And it's got a long, 13-year track record now. So this is my email to John Bogle, who was a founder of Vanguard in February 2010. So roughly 4 years after I launched the value fund and 2 years after we launched the Quantum Nifty ETF, which is tracking the NSE 50 index, I wrote this email to John Bogle. I said, while we have an ETF, we believe more in the actively managed style. We are value investors. This is because the indices in India are still immature and evolving. Typically, the index creators change between 10% and 20% of the stocks in an index in any given year. The losers are taken out and the surging stocks are counted in. Of course, there is no transaction cost for such a move, but if an ETF was to mirror this, and we have one, Quantum had one, but with a 15-month track record, actually it was 18 months then, the real cost of mirroring the changes in the index would lead to huge tracking errors over time because the index has no cost of changing, whereas quantum, Nifty, NSE 50 Nifty index, ETF, would have a cost of changing. There would be a separation, a tracking error between what the fund does and what the index is not doing, which is taking a transaction cost. So I alerted Mr. John Bogle, the founder of Vanguard, uh, via this email to him in February 2010. Sadly, Mr. Bogle passed on 2 years ago, but I think his spirit and his driving force is still there. We can see that in the success of Vanguard. This is Mr. John Bogle's response in February 2010. He says, "Hi, Jeet. I'm so sorry that I can't meet you. I'll be traveling all next week. For all the reasons I've expressed over the decades, I strongly prefer classic indexing over active management, even over value investing." The red part is my text. I made it red, but this is his words. But the indexing strategy you describe in India sounds just plain foolish. Good luck in your work. Best, Jack B. So John Bogle also went by the name of Jack. John and Jack are kind of synonymous in the American name. And when you call someone by names, it can be John or Jack. So Jack Bogle. Now, what did John Bogle, the founder of indexing, and Vanguard today manages $6 trillion, what did he find that was plain foolish? And it's what I indicated in my email to him. There are too many frequent changes. And in some sense, is it a cheating index? I ask myself. And this is a comparison of the major indices in India, the S&P BSE 30, the S&P BSE 100, the S&P BSE 200, and then the Nifty 50, as it's called, and then the Dow Jones 30 in the US. Look at all the calendar years, from calendar year 2003 onwards, all the way till calendar year 2020. Look at the last row, the Dow Jones marked in red. See how few changes are made in that index. Now, let's go 30 stocks. Let's go right to the first row. BSE 30 also has 30 stocks. Look at the number of changes there. And there's only 1 year, 2014, where there was no change. Go to the BSE 100. Sort of 100 stocks in the year 2003, 4, 5, 6, when the brick story was very hot, 2007. The BSE 30 index was changing roughly 15 to 20% of the names in the index. Remember Unitech? Remember DLF? These all were the hot property stocks. They were not a part of the index, but the stocks were flying. And the index guy said, hey, historically, backward looking, these are big market caps now. They've got high trading volume. We got to have them in the index. So they put them in the index. And they had to take something out. BSE, same thing. So this is what's happening. Whenever the stocks get hot and they've forgotten to put something in, or something which was very small, like a Unitech becomes very large and very popular, they got to put it in the index. Now, the index fund or the ETF, which is mirroring this index, right? When you bring a stock in or you take a stock out, there's a lot of rebalancing going on. So let's take the example of Satyam. So Satyam, as you know, in January 2009, Mr. Raju said, I'm getting off the Tiger's back and I've stolen or taken away $1 billion from the company. So what did the BSE 30 and the other index providers do? They took Satyam out of the BSE 30 index. Now, when you take Satyam out, there's only 29 stocks. Well, the name of the index is BSE 30. So you got to put one stock in to make it 30. So they put in Sun Pharma, if I recall at that point in time. So now you're back to 30. But when Satyam went out, maybe its weight in the index was 2%. Now, when Sun Pharma comes in, its weight may not be exactly 2%, maybe 1.5. Its market cap, maybe 1.5%. So if they bring it back in and it's only 1.5 and they've taken out 2, there's a 0.5% difference. So what do? The other 29 stocks, they have to trim proportionately, right? Or they have to actually add proportionally another 0.5%. So the other 29 stocks will add 0.5%. That all requires someone's got to pay brokerage. If you go out and buy shares and you tell your broker, buy me 29 shares, 29 company shares, he'll say, where's my brokerage? And the government will say, where's my STT, et cetera, et cetera. There are transaction costs that are involved in all these things. But the index providers can bring it in, take it out, and there's no transaction cost. A fund which is trying to replicate an index will incur these transaction costs. These are real. So what's happening actually when you look at these indices and the number of changes in them between all the India-based indices, it's quite insane and certainly very different, which is why it caused Jack Bogle, to use the phrase and use the sentence, but the indexing strategy you describe in India sounds just plain foolish, right? Now, yes, there have been some changes, may not be that dramatic, but you can still see there's activity going on compared to the Dow, compared to the US indices, etc. So these are some of the hidden things that are not discussed when people talk about passive versus active investing, passive index mimicking versus active indexing, and quantum long-term equity value fund is one such active fund. And there are many, many others. So are we there yet? Is this the time to encourage you to invest in an ETF or an index fund? Is this the moment we have been waiting for decades? Keep in mind, we launched Quantum Nifty ETF in 2008. So we're waiting for this day when a dumb index will do far better than the supposedly smart humans we have as fund managers and research analysts. Is it time to place your money in the hands of an algo computer following some historical logic, which decides what stocks your life savings should be invested in, and then is replicated by a simple index fund or an ETF that mimics that underlying index? Is this the time? Come, let's walk on this journey together and find out. So, a few disclosures. Quantum Long-Term Equity Value Fund is classified by SEBI as moderately high risk in the risk-o-meter. As I mentioned, this was launched in March of 2006, and it's a fund that seeks long-term capital appreciation and invests in equity shares of companies that are around pretty much within the BSE 200 index. The Quantum Nifty ETF is an open-ended scheme. It replicates the Nifty 50 index, and it also seeks long-term capital appreciation and invests in those securities which comprise of the Nifty 50 index. And in the riskometer of SEBI, it's also classified as moderately high. It is equity. Equities are moderately high risk. So the risk profiles are the same. Now, the long-term equity value fund is in the red, and the Nifty ETF is in the blue. Now, the base here for this we've taken as July 2008, although I indicated that the value fund was really set up 2 years ago in March 2006, but there was no Nifty launched by Quantum then, Nifty ETF. So we made them the same start date. And as you can see, over the period of time, there have been periods of underperformance, not but point to point, as of of uh, December 31st, 2020, the long-term value fund has done better, though its performance in the near term has been weak, and we'll come to that in a while. So these indices are also poorly constructed. They're backward looking. They're looking for winners of yesterday. And these winners of these indices may lead to unintended bets. So look at the sector of financials. So in the value fund, where you pick and choose which stock you want to be in, and de facto which sector you wish to be in or don't wish to be in the financial sector, the index, the quantum Nifty, which replicates the index, has a 39% weight. And whereas the quantum long-term value fund is only 29%. Look at consumer discretionary, second row from the top. Quantum long-term equity fund believes, value fund believes that, hey, there's going to be a good play in consumers. We should be overweight. So they got 17%. The index has only 6. So there is an overweight by quantum in consumer discretionaries in the quantum long-term value fund compared to the Nifty, quantum Nifty ETF. And in the financials, there's an underweight. And there are other differences that occur across the portfolio, including utilities, second row from the bottom, where there is 10% weight in quantum long-term equity value fund, and there is a 2% weight in the quantum Nifty ETF. So the quantum value fund is 8% overweight. Plus, the quantum value fund has cash. They don't believe, for some reason, they don't think that the markets are right. They think the valuation may be expensive. They're waiting for shares to come down. They're holding 7% cash. And in the Nifty ETF, there is no cash. So these are some of the differences that are there. But keep in mind again that the quantum long-term value fund is making a decidedly active bet. That's why it's called active management versus an index which is passive, which is not making active bets, looking at data. So there's also a higher concentration risk. So in the quantum long-term equity value fund, the top 5 stocks account for 32.78% of the index. To the right, the quantum Nifty ETF, which reflects the NSE 50, accounts for 42.45% of the top 5. And in the top 10, the quantum long-term equity value has 50.47%, and the Nifty has more at 61%. So it's more concentrated. Good or bad, time will tell. The index funds and ETFs should underperform the benchmark because, like I mentioned, there's costing. And a quantum Nifty ETF has costs involved, the buying and selling. So you look at the track record since inception of the quantum Nifty ETF, which was July 2008 till December of 2020, against the Nifty returns, you can see that it has underperformed. So pretty much in every year, by definition, it will underperform. So a very small difference, but it will underperform. And the quantum long-term equity value fund, when compared to the BSE 30 index, which was from March 2006 since inception. So the inception dates are different for the quantum Nifty ETF and the quantum long-term value fund. So over the last 15 years, roughly, it's given a 13.67% return after fees. This is net asset value. So after fees and expenses. And the S&P BSE 30 index total return index with dividends reinvested has given you 11.91%, even though there's no transaction cost that is accounted for when the BSE 30 takes stocks in and out of the Sensex. But look at the 10 years numbers, and clearly the quantum Nifty ETF row 1 in 10 year has done slightly worse than the quantum long-term equity value fund. In 7 years, the passive Nifty has done better. Look at the 3-year number. The quantum Nifty ETF has given a return of 11%, and the quantum long-term equity value fund has had a miserable 4% return, and the BSE 30 index has had a 13% rate of return. So there are periods of time, very clearly, when an index can be far superior to an active strategy such as quantum has adopted of the long-term equity value fund. And this highlights it very clearly. So that excessive outperformance in the years 2018-19 by and large has kind of spilt over into 1 year numbers and gone back to 5 year and 7 year right numbers. So it's been a quite a drag on Quantum's long-term track record by having 2 years. It was 2018-19, if I recall, when the value fund did a lot worse than the BSE 30 index or the NSE 50 indices. We'll come to that later on the other discussion. But just to explain something, statistics like standard deviation is not risk. So you'll often hear this. The risk of an index is lower. And then they'll show you a standard deviation chart. And the standard deviation, for those who've done statistics, just shows the movement around the mean. So if this is your mean, the standard deviation is what moves around it. It's a mathematical equation. It does not tell you whether the company is a crooked company or a bad company. It just tells you what the share price was or what the NAV was and what the movement was around the NAV. That's all it tells you. So it's not risk. It's an up and down movement. It's a mathematical equation to compute the movement of a stock for a whole bunch of other reasons, but not risk. And that's where you said the governance risk are involved. So active funds, like the value fund, like other fund houses have value funds, have active funds, they can actually size their portfolio and their valuation. So look at the PE ratio, expected PE ratio for 2023 March. This is the Bloomberg consensus estimates on companies that we own and companies that comprise the Q Nifty 50 ETF. So based upon the analyst, sell side analyst consensus view, the Quantum Long-Term Equity Value Fund is trading at 13 times PE ratio compared to 17 times PE ratio for the Quantum Nifty 50 ETF. The EPS growth rate, again, based on consensus numbers, is 23% for the Quantum Long-Term Equity Value Fund portfolio and a much higher 28.99, so nearly 29% for the Quantum Nifty 50 ETF. And if you divide the PE ratio with the EPS, you get what's called the PEG, price to earnings growth ratio, the PEG ratio. And they're little different, 0.56 for the Quantum Long-Term Equity Value Fund and 0.59 for the Quantum Nifty 50 ETF. What this really says is that for every 1 rupee of potential earnings growth, you're paying 56 paise in the value fund. And for every 1 rupee of potential growth in the Nifty 50 ETF, you are paying 59 paise for, to buy it. So it's a very marginal difference. Look at the number of stocks. It's 29, or rather number of companies. There are 29 companies in the Quantum Long-Term Equity Value Fund, and there are 50. One of the companies has 2 securities, so there are 51 securities. When there's a rights issue or something, it's a security, but it basically mirrors 50 companies in the NSE 50. And here again, the historical PE ratio of the things, as you mentioned, is pretty high for the long-term value fund. Looking backwards, is 18.6. For the Nifty 50, looking back, it is 33.5. So these are the other things that tell you about the composition of the portfolio within the index and within, for example, the actively managed value fund, where look at the last row, percentage weight in the portfolio of stocks where the PE ratio is more than 30 times historically. So for Quantum Long-Term Equity Value Fund, it is 17% of the portfolio. And for the Nifty 50, Q Nifty 50 ETF, it's nearly 50%. Half the stocks are trading at a PE ratio of more than 30 historical PE ratios. So a fund manager doing an active fund can actually say, well, you know what, I'm willing to take more risks. Let me put more money into the stocks in the last row, or let me take some bets off the table. It's sounding too expensive. An index can't do that. An index just has to live with whatever the outcome is of the stocks that it owns in the portfolio. So we've not even come to the part of truly understanding or evaluating risk. Standard deviation, as I showed you, is a mathematical equation. It's not risk. It merely measures the movement of something around the mean. This is your mean, and where does it go? the up and down movement within a cluster of data points. Risk is a Satyam, a Unitech, a Yes Bank. There are other companies out there that we don't like. We don't know when they'll blow up, but they're out there in the index. They're all part of the index at one point in time, these three stocks. And there are other stocks in the index today that could blow up. Maybe. Are there stocks in an actively managed fund that could blow up? Sure, there are. But an active manager potentially can exit a bad stock pretty quickly. Doesn't have to worry about getting a replacement. Like when they took Satyam out in Jan 2009, they had to worry which stock will replace Satyam. We can just sell the stock and hold cash and wait till we find a proper replacement. So, is active management dead? Is index investing the way to go? Or is this a lazy option, index investing being a lazy option, because you don't have the time to read about what quantum mutual fund does or other fund houses do? Make your decision, but after understanding the facts. Again, the long-term track record of Quantum Long-Term Equity Value Fund has been better since the compared to Quantum Nifty 50 underlying ETF. But as you saw from some of the tables, 3 years, 5 years, 7 years numbers did not look very good. And there are reasons for why value as a style may not be working well in a growth market. There will be other growth funds that could have done much better than the Nifty 50 and also better than the value fund. But the discussion really today is whether you fully understood what the risks are in having an ETF which replicates the index, or whether to some extent it's fine. And was John Bogle, the founder of Vanguard, was he wrong when he characterized and said it's plain stupid the way the index is being built? And believe me, there's been no change. You saw the table. There are very similar patterns of changing the number of stocks in an index even today. So index investing may not be yet the way to go, in my opinion. And when it is, I will certainly let you know. I'm sure my colleagues at Quantum will let you know. We have already built the product. We have a 12-year track record of an index which is out there and it's waiting in the wings. The solution, if we find that passive investing is far superior, the solution from Quantum is already there. We haven't showcased it to you. We haven't shown it to you yet because we're not really convinced that John Bogle's criticism has yet been taken to heart by the people who create the various indices in India. So thank you very much. I hope this enlightens you a bit and makes you ask the other level question, which is, hey, if active management is still better than passive management following an index or an ETF, then which active manager should I be investing in? Which active manager has a good track record? Those are, in my view, the more important questions to ask. And I know that with Personal FN's help, you'll be able to get these solutions, because I know that Personal FN for decades has been working on trying to find mutual funds from the 400 equity mutual funds out there. They've been trying very hard to ensure that they find for you the best mutual funds. So thank you so much. And I hope you enjoyed this.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.